Picture this, the headlines are screaming. Red charts are everywhere. Your favorite crypto influencers have gone quiet, or worse, they're posting panic-filled videos. Your portfolio, which once looked so green and promising, now looks like a crime scene. This is the reality of a bear market, and frankly, it's terrifying for most people. The natural human instinct in the face of this much negativity and financial pain is to run for the hills. We are hardwired to avoid danger. So, how do you conquer this intense fear and actually take advantage of a bear market? The answer isn't some complex trading algorithm or a secret crystal ball. It's a beautifully simple, almost boring strategy called dollar cost averaging, or DCA for short. In the simplest terms, DCA is the practice of investing a fixed amount of money into a specific asset at regular intervals, regardless of its price. For example, you might decide to buy $100 worth of Bitcoin every single Friday. It doesn't matter if Bitcoin's price is soaring at $70,000 or has crashed to $20,000. You just buy your $100 worth, like clockwork. The magic of this approach lies in its consistency. Let's reframe the terrifying image of a bear market. Instead of a house on fire, think of it as the biggest sale of the year at your favorite store. Imagine everything is marked down by 70%, 80%, or even 90%. This is exactly what a bear market is for high-quality long-term assets like Bitcoin and Ethereum. These are not speculative meme coins with no utility. They are foundational technologies with robust networks, growing developer activity, and increasing real-world adoption. When their prices fall dramatically, it's not necessarily a reflection of their fundamental value disappearing. More often, it's a market-wide panic. During a bull market, when prices are rocketing upwards, buying a full Bitcoin or a significant amount of Ethereum can feel impossibly expensive for the average person. A bear market completely flips this dynamic. Suddenly, the same amount of money that would have bought you a tiny fraction of a coin during the peak can now buy you a much more substantial position. Let's talk about the original gangster of crypto, Bitcoin. Since its creation, Bitcoin has been declared dead by the mainstream media over 400 times. It has experienced multiple brutal bear markets where its price has crashed by over 80%. Each time the narrative was the same. The bubble has finally popped, this is the end of Bitcoin. It was all just a fad. Consider the 2017 bull run. Bitcoin soared to nearly $20,000, a price that seemed unimaginable at the time. The public went into a frenzy. Then came the crash of 2018, a long and painful crypto winter. The price of Bitcoin bled out, eventually bottoming around $3,200, a staggering drop of more than 80%. But what happened to the people who used dollar cost averaging through that entire downturn? They were buying Bitcoin at $10,000, then $6,000, then $4,000, drastically lowering their average cost. Their patience and discipline were rewarded spectacularly. By the end of 2020, Bitcoin had reclaimed its $20,000 high, and in 2021, it rocketed to over $69,000. Bitcoin isn't the only crypto asset with a story of epic comebacks. Let's look at Ethereum, the world's leading smart contract platform. Ethereum is the foundation for a massive ecosystem of applications, including decentralized finance, non-fungible tokens, and countless other innovations. In the 2017 to 2018 cycle, Ethereum's rise was even more meteoric than Bitcoin's. But when the bubble popped, the crash was even more severe. Ethereum's price collapsed by over 94%, bottoming out at around $80 in the depths of the crypto winter. However, while the price was collapsing, the Ethereum developer community was hard at work. They weren't focused on the daily price chart. They were focused on building. Fast forward to 2021. The DeFi and NFT markets ignited, and almost all of that activity was happening on Ethereum. The demand for ETH skyrocketed, and its price soared to a new all-time high of nearly $4,900. The DCA investors who had been patiently buying at $100, $150, and $200 saw their positions increase by 20, 30, or even 40 times. One of the biggest advantages of dollar cost averaging has less to do with math and more to do with psychology. Investing is an emotional roller coaster, and our brains are, frankly, notoriously bad at making logical decisions under pressure. The two most powerful emotions that drive poor investment choices are fear and greed. DCA is the ultimate antidote to these destructive impulses. By committing to a fixed investment schedule, you are essentially putting your investment strategy on autopilot. You remove the decision-making process from the most volatile moments. It's Friday, so you buy your $100 worth. This strategy also helps you reframe your perception of a falling market. For a DCA investor, every drop in price is a victory. You actually start rooting for lower prices because you know that your next scheduled purchase will now buy you more of the asset, lowering your overall average cost. This mental shift is incredibly powerful. While dollar cost averaging is a simple and powerful strategy, it's not foolproof. The first and most common mistake is stopping the process halfway through. Many people start a DCA plan with good intentions, but when the market drops 50% and keeps falling, their nerve breaks. They stop their regular purchases, convinced the asset is going to zero. This is the cardinal sin of DCA. Another major mistake is DCAing into the wrong assets. This strategy works wonders for fundamentally sound blue-chip cryptocurrencies like Bitcoin and Ethereum that have a high likelihood of long-term survival and growth. However, applying DCA to a highly speculative, low-quality meme coin or a project with no real utility is like consistently adding water to a bucket with a giant hole in it. A third trap is trying to time your DCA purchases. Some investors will say, "I'll DCA, but I'll wait for a bigger dip before I make my weekly buy." Finally, a critical mistake is not having the cash flow to sustain your plan. Before you commit to investing $100 every week, make sure that is a sustainable amount for your personal budget. Ultimately, the path to extraordinary returns in investing often lies in being a contrarian. This means having the courage to do the opposite of what the crowd is doing. When the masses are euphoric and piling into the market driven by greed, a contrarian is cautious. And when the masses are terrified, selling everything in a panic, a contrarian sees a historic buying opportunity. The markets are a giant mechanism for transferring wealth from the impatient to the patient. A bear market accelerates this transfer at an incredible rate. Your consistent automated DCA purchases are your tool for positioning yourself on the right side of that wealth transfer. This contrarian approach, powered by DCA, builds not just wealth, but also character. In summary, the bear market is not something to be feared. It is the arena where smart investors are made. By embracing dollar cost averaging, you can turn market volatility from a threat into an advantage. This strategy allows you to accumulate quality assets like Bitcoin and Ethereum at discounted prices, removes destructive emotions from your decision-making, and positions you for the inevitable recovery. I encourage you to dig deeper, study the history of market cycles, and equip yourself with the strategies that will help you not just survive, but truly win in the world of crypto investing. If you found this valuable, make sure to subscribe to DCA Crypto Investor for more educational content on building wealth through disciplined cryptocurrency investing.